Yeah, thanks everybody for joining. I really appreciate everybody that's joining for this call. It's really, I love this opportunity. It's always so nice to, instead of just always posting stuff on the feed, it's difficult to convey some of the stuff that goes on in the back end. So it gives me a really great opportunity to present my case to you. I think that the idea with these kind of quarterly calls is like almost like these companies do on a quarterly basis. You've got the CEO or the CFO presenting the earnings of their company. This is me presenting the earnings or the portfolio performance for the quarter, and just talking to you about some of the strategies and the vision for the future. So I really appreciate you guys joining. I'm going to go through a couple of slides. Hopefully you can see my screen. So just some of the topics we will be covering there on the agenda that you can see. So first up, just a little bit about me. Who is Reinhardt Coetzee? This portfolio that you're copying. There's a person behind that. So I'm from Johannesburg in South Africa. I work for a fairly large ICT firm as a consultant, working on all sorts of industrial automation projects. So that's really my background, is in engineering industrial automation. Specifically, I specialize in things like big data and analytics. That's kind of my area of expertise within that, and something that's my passion. So I've worked for a couple of large firms in the past as well. You can have a look at my profile. There's a couple of different ways of connecting with me. If you want to read up a little bit more of my background, my experience, more than welcome to connect with me on LinkedIn. But yeah, that's me, and we'll go through the next section. So the first thing I want to cover today is, I don't want to hide away from it. I want to go straight into this, is the performance. So some of you on this call might have been copying me for quite some time. I think, as far as I can see on my stats, I do have quite a number of copiers that's been copying me for a long time, and that's awesome to see. And I also have a lot of new copiers, especially towards the end of last year. I think with the markets rallying and everything, the portfolio did really well, so again, a lot of copiers. But it is also just the nature of investing in general, especially retail investing, I suppose. A lot of people joining and changing investments. Hopefully I can show you some of the statistics today and maybe helping you decide why not to do that. As we're going through it today, it's like literally every single time it feels like I'm doing one of these calls, the market is in disarray. Tech stocks dropping, and we're just looking at my eToro screen down there. The portfolio is down 3.6%. So like everybody's like, let's run for the hills, let's get out of this. I feel like I can calm your nerves. This is just all part of how the market behaves. But let's get right into it. So if you look at the performance, it's been really good. In terms of that chart, eToro only goes back about 2 years, as you can view on the chart. I've also keep some of my statistics, so I'll show you a little bit longer trend than that. But over the last 2 years, including this year, which has been a bit choppy, you can see this year we're a little bit down for the year. Today we're now another 3%, almost 3.7% down. So it has been a bit up and down this year. So, but like I said, if you've been copying for quite some time, depending if you've been copying for a year or 2 years, you're still up quite significantly versus market-rated performance. If you compare that to the S&P 500 or even the Nasdaq, which I kind of like to use as my benchmark. But yeah, the fact is that the portfolio is down this year. It has been very up and down. It's almost like the market, you take 2 steps forward, 1 step back, and that's just always the case. This year, there's been a couple of factors that's been playing into that. One of them being that 2020 was such a good year and such a drastically different year for obvious reasons with the pandemic. I presented this kind of slide towards the end of last year with a previous call like this in November. And some of the things I just highlighted there, we had an incredible year. So the Nasdaq composite was up 44% in 2020 versus a 14% 10-year average. So it's not normal. So with that kind of performance, you're bound to see these kind of choppiness and pullback in the markets. And there's a couple of reasons, we will get into that as well. But there's lots of things going on in the market. You've got a combination of when the pandemic started, a couple of months into it, they're still calling it one of the worst economic crises in the world since the Great Depression. But yet the stock market has rallied and it's gone up quite a bit. You've got this combination of interest rates being historically low. We've never seen interest rates in the US being so low. Combine that with all the free money that's been injected into the system with the stimulus checks. On the market side, like I said, you've got this, the economy that should be in turmoil, which it is for many people, for many businesses out there. But in the stock market, you've got some of the best performing stocks being companies that are unprofitable. Some of these IPOs that have been performing better than IPO. I think 2020 was a better IPO for IPOs than it's been since 1999. You also look at companies having market valuations now into the billions that won't show any real value, real revenue for the next couple of years. So you get to a stage where you've got to ask yourself, how long does this last? So you've got a lot of these factors playing in, so you're bound to have a situation after a year like 2020 where the market is unsure of itself. When you see these price fluctuations like we've been seeing in the last couple of weeks, since March, I think it's really started, volatility started coming in, especially in technology stocks. It's just the market trying to figure out how to price these stocks. So a big reason, and one of the biggest reasons for this downturn in technology stocks this year has been worries about inflation and interest rates. So on the chart there, that's one of the biggest indicators, is the 10-year Treasury yield. So what you can see there is, the yields are still kind of lower than it has been for the last couple of years, but it's that sudden rise, uptick in the yield curve, which normally spooks investors, which we're seeing again today, combined with a couple of other factors, where traditionally, if you see this starting to happen, it normally foretells that inflation is coming, and to curb inflation, the central banks typically raise interest rates. When that happens, it's not the best kind of thing for growth stocks, because growth stocks are very much valued on their future earnings. So you kind of see this rotation in the stock market going out of tech stocks in 2020. It was obviously, stay-at-home, work-from-home stocks saw a huge pull forward in terms of their numbers. Subscription revenue for cloud stocks, for things like Netflix, for cloud-based companies like Azure, you just saw this huge pull-through in terms of revenue in their earnings. So they had fantastic years, which inflated the stock price. But as the economy starts opening up, people are starting, as a combination of investors out there taking profit, booking those profits, and rotating into other sectors, which is as you can expect. Also, just on that, if you haven't seen it, the eToro actually, they go into a lot more detail specifically in this kind of thing. So if you haven't seen that, this eToro's quarterly report, so I advise you to go and check it out. They go into detail a lot more about what's causing this, and also in terms of technology, and not to be scared of what's happening. But technology still is a fantastic investment, and with all the different copy portfolios, you'll see eToro has a lot of those kind of investment trends is bundled into this portfolio, my portfolio. So just back to the performance. If you look at that chart, obviously there's a lot of choppiness in this year. It doesn't look great. We're a bit flat, or just under positive percentage for the year. If you zoom that out, like I said, I keep track of everything since I started in eToro, so that's kind of the chart from the day I started in eToro. So if you look at it that way, you can see these kind of things happen all the time. And it looks a lot easier when you look at that from a long-term investing perspective. You're looking at a chart like that. So that chart area highlighted, that's basically the chart you see on eToro for the last 2 years. But you can see just before that, in 2018, there was a combination there of also that the yields on the 10-year note that was also causing concern. You had the combination of trade wars also causing concern there. There was a lot of volatility in 2018 as well. So if you started copying back then, it might have also been a while for you to be profitable again into the future. But looking at a chart like that, you can see this is just like normal market movements that happens, and we'll go through it a little bit more in detail as well. So this just details my performance since being on eToro, since starting in 2016. So every year since I've been on eToro, I've managed to outperform both the S&P 500 and the NASDAQ. Even in 2018, when I underperformed, I think I track it a little bit differently than what you see on eToro. I think on eToro I've got a minus point something percent. But even with that minus point something percent, I still managed to outperform the S&P 500 and the NASDAQ, which dropped a little bit more in 2018. But it just goes to show that over a longer period of time, the portfolio has been able to outperform both those indexes every year. So this year, in 2021, you can see it is underperforming both of those indexes, but I'm still confident that by the end of this year, we'll see a change in that. So this slide just shows you a little bit about, looks a little bit all over the place. I just wanted to highlight this quickly because this is basically the daily return for the last 20 or so trading days. Again, just looking at the portfolio versus S&P 500 and NASDAQ index on a daily basis. So I've had a couple of comments since in this year because of some of the downturn, concerns around the portfolio seems to drop by a lot more than even like what the NASDAQ is dropping. So the NASDAQ obviously very technology oriented index, but you'll see also on the positive days the portfolio also tends to outperform both those indexes by quite a bit. So that's why you'll see again, if you extrapolate that over a longer period of time, you get this quite decent outperformance versus those indexes for the portfolio. And that just this kind of volatility on a daily basis is always difficult. So it is a portfolio of 50 stocks versus 100 or so in the NASDAQ 100 or 500 plus in the S&P 500. So it is going to be a little bit different on a daily basis. And what you do tend to see is when you're on a downturn, like we are a little bit at the moment, the portfolio, because of that concentration in those 50 stocks, you're bound to see underperformance while the whole market or the technology sector is going down. But again, like I said, on the flip side, it tends to outperform when the market is going up. And I think as most of those long-term trends will show you that over time, the market tends to go up, and it spends more time going, stocks in general just do spend more time going up than they go down. So it's been a strong all-time performance since I've been in eToro. That translates into a 35% annualized return versus the S&P 500 70% or 316% total return, and 84% return that we saw in 2020, which was phenomenal. It beat the NASDAQ index by almost double. I think the NASDAQ returned like something like 44-47% in 2020. Depends if you're counting in dividends or not. So it's been a really good performance, even counting in where we are this year, which is not so great. But if you've been copying for a year, you're still probably sitting at about an 80%, 70+% return for the last 12 months running. So I just want to spend a little bit of time on this as well. So, we talk a lot about these macro kind of events, yields going up. You've got COVID-19, the pandemic still out there, worries about second wave, third wave. See what's happening in India. It's a concern even here in South Africa. South Africa, luckily, we've been fortunate enough, surprisingly, to keep our numbers very low. We've had a second wave just like most of the UK and Europe had, but our numbers are very low. But I think everybody's concerned what's happening in India could spill over. So you've got that, and you've got the COVID vaccines rolling out and opening of the economy. You've got worries about inflation, Biden policies coming in with taxes and things like that. But I think the key thing that I want to make with this chart is, do any of those things really change the way inherently in how I invest? And the answer is no. It's very it is obviously very important to know about all these things going on, and how it affect me is maybe percentage-wise how much more cash I want to keep on hand to be able to reinvest back in the market and to curb some of the volatility, which we'll go into a little bit later as well. But just to point out, these things happen all the time. It's been happening. It's not going to stop happening. You're going to have these major events, and you also have this noise of people speculating and saying the stock market will crash, like they have been saying for the last 10 years, the bull run. Doesn't stop, doesn't change the way I invest. I look for quality companies, quality businesses. I look for leadership. I look for the products and services I use in my daily capacity, products and stuff that I use for my projects and things. Companies that I know very well, that I've been following for a long time since I've been doing this, and I stick to them. I keep reinvesting in those companies, and over a long enough time period, I think that's one of the best ways to win in this market. So these are the best performing stocks on the left and the worst performing stocks on the right for the last 12 months. So as you can see, some stocks way outperforming the market and some stocks underperforming the market, but most of them, or all of them, that's currently in the portfolio has been in positive territory for the last 12 months. Year to date, though, it's a different story. So I honestly, I'll go through a little bit later, but for me, this is opportunity. It's not the case if it's like speculative stocks like GameStops and the things like that we've been seeing, but if it's a company with great fundamentals, with great products, leadership, I see this as an opportunity in making volatility work for you. So just looking at the weighting of the portfolio, we can see there's quite a few stocks in there at the moment. Shopify being our biggest holding, both by investment. I think it's the third most by outperformance. It's grown into the largest weighting in the portfolio at the moment. So I wanted to spend a little bit of time on that, taking everything in consideration we've just been talking about. So this is the last 5 years performance of Shopify. It looks fantastic. It's performed at its high, across the 4,000% mark. So that's a multi-bagger stock. It's a fantastic company. But it's down by 20%. The earnings came out now recently, and it absolutely smashed all kind of expectations, as it's been doing for the last couple of quarters. I've been following this company for quite some time. I've held it since, I think, day one that I've on my portfolio here in eToro. The last quarter, year-on-year revenue increased by 110%. For a company this size, that's phenomenal. So that's year over year. So obviously that's pulling in that fantastic revenue-driven increase because of the pandemic. Everybody going online, people with their shops going into e-commerce. But sequentially, on a quarter-to-quarter basis, Shopify also outperformed December. Where they already had this huge pull forward in terms of volume, gross merchandise volume and everything on the platform. So this company is by all means, in all sense of the word, firing on all cylinders, and it has been for a while. What's interesting to note is if you look at where the stock price is at the moment, down by 20%, interestingly enough, when the earnings released on the 28th, a couple of days ago, the stock price jumped by 12%. Subsequently, I think in the last couple of days, it's given most of that back again, dropped by 4-5%. What's interesting to note about a company like that, if you look at this chart, that's exactly the same chart, exactly the same data points, but it's a top-down chart. So it shows you the percentage that this stock is off its all-time high. So you can see it's currently about 20% off its all-time high. But what's interesting to note is how many times this actually happens. So in the last 5 years, the amount of times that Shopify has gone down by 20%. There's been a few times. More than 10-15%, quite a few times. But in general, and this only applies to these good companies, not to any stock, but in general, these kind of companies that's performing the way they are, that's got these demand for the products and services they have, generally spend more of their time at an all-time high. So I love this quote, like an all-time high is normally after an all-time high comes another all-time high. It's kind of true for stocks like these. So the chances of a Shopify being down 20%, reaching another all-time high, given the demand for its products, given its leadership, given its balance sheet, is exceptionally good that it's going to reach another all-time high. So for me, this is an opportunity to reinvest in some of these stocks. So just again, that is exactly the same chart. If you look at it this way, it looks phenomenal, but if you look at that other chart, it looks a lot more scary. But you have to have that conviction to stay invested in that chart while while the stock sometimes drop by 20% or more. And this applies to most of the companies in the portfolio. Shopify is our biggest holding, and that's why I just wanted to highlight it. But you can take this kind of thing to Tesla, Amazon, and I'll show you Amazon just as a comparison. Another thing also just to note here, and one of my key things that I also try and get across is, a lot of people ask me, why don't you close some of your trades? So a lot of you have come to me with questions like, you see that I don't close a lot of trades, which is 100% true. And Shopify actually have closed quite a few trades, and that is only because Shopify has outgrown the portfolio in terms of the exceptional performance by, it would have a weighting of more than 10%, which is just one of my kind of rules, that I don't want to be concentrated so much in one particular stock. But if you look at that chart, if you look at the middle 2019, the stock was doing really well. So at around about that time, you get a lot of comments like, okay, but why are you not taking any profit? So for me, the answer is there. I still believe in this company. I still think there's a lot of growth opportunity going forward. I think it's just getting started. So why would I want to close it and have less exposure to the stock? I actually want more. So you get the question when it's at an all-time high, like, okay, is the stock going to really grow anymore? For me, the answer is yes. So why would I want to sell it? Then you look at towards the end of 2019 when it lost a lot of value. Then you get the opposite question. People will say, well, why are you still investing in the stock? It's clearly on a downturn. Well, if you look at the rest of the chart, obviously the story speaks for itself. So that really comes with, if you follow these companies closely and you really believe in the business, it's just something to take note. So I just wanted to show you the same kind of thing for Amazon. One of the best stocks for any investor to have held in the last 10, 20 years. If you look at that performance, amazing. If you look at the same thing again on the flip side, the top-down approach, the percentage of time that in that same time period that investors would have had to hold on while the stock was down 20, 30%. So that's the kind of thing to just take note in terms of investing in stocks and investing in stock markets and technology stocks in general. Is that volatility. So it gives you this kind of weird paradox. So a stock hits an all-time high, investors don't want to invest at an all-time high because the fear is it's at an all-time high. Nobody wants to invest high. And on the flip side, when the stock drops by 20%, people also don't want to invest because it's just going to drop further. So again, if you take that long-term view, it really doesn't matter. As long as it's a good business, those businesses tend to keep on growing. It's like winners keep on winning kind of thing. So at the moment, if you look at some of the stocks in the portfolio, we've got some companies down 20, 30, even 40%. So Teladoc Health down 40% at the moment. So it also just came out with its most recent quarterly results, and it was a fantastic quarter. They grew revenue, they grew the business in all the areas that matter. Subscriptions were up. Utilization of the platform. If you don't know Teladoc, it's the teleconference for telemedicine company. So obviously it was a huge 2020 stock, but there is still so much growth left in that company, just in the way things are changing. More and more people are using that platform now than they did even in 2020. But because of that pull forward in terms of revenue and the stock price just ballooned, it is a question of valuation. So, that is the kind of stock that will see this kind of volatility. But again, for me, the chances of a company like that hitting an all-time high again sometime in the future is very good. It takes a long time though. It can take time. When you listen to these earnings calls, to these companies, when the CEO talks or the CFO talks, they don't talk about the next couple of months. Their strategy, their vision for those businesses is really, it's years out. So it might take some time for these stocks to come back to an all-time high and higher. But the point is for me is investing in these stocks and sticking to these businesses. So a lot of people also asking, why don't you investing in companies like cyclical companies like oil companies, travel companies, airline companies? For me personally, I invest mainly in the companies, the stuff I know, the technology I use, the companies I'm interested in, I follow. So I would rather reinvest in these companies that's down 20-30% that I know are fantastic businesses, rather than changing and chopping and changing and chasing profits all the time. I think that's a mistake that in general a lot of people do. Not saying that some people can't do it. And we've got some popular investors, I think, that does multi-asset strategies brilliantly. Personally, for me though, I like to focus on what I know and the companies that I know, and technology is just that. So yeah, the other thing is, like I said, you can chase these kind of profits, but if you, from each individual person sitting there copying me, it's worth thinking about it like copying me is almost like copying or investing in a technology traded fund, right? You've got to look at your own diversification. So you could say, if you could decide to invest something like in an ETF that tracks the NASDAQ, and you want to commit 70% of your equity in that, leaves 30% in cash, or put 30% into something that tracks ETF that tracks oil industry. For me, I'm all in technology, so all my funds is invested in this portfolio. So for me, that's where I see the biggest growth opportunity for my money to grow. But yeah, like I said, it is up to everybody's own risk appetite, how long, what kind of time frame you've got to invest. All those things come into play. So this chart also just interesting, just running some of the numbers on my portfolio. So some of you might have been copying for a long time. Like I said, some of you might have been copying for just in the last couple of months, so you might be down quite a bit, a couple of percent. So it's frustrating. I know it's frustrating. If you look at this chart though, this is again my entire history on eToro. So for some people, copying back in September 18 at a peak, they would have gone peak to valley about 25% down. I don't know how many copiers would have stayed through that period. Probably not a lot. I would like to think some of you are still copying from that time. But that would have been the worst possible time to start copying. So you would have been down 25%, and you would have waited about a 6-month period before you would have may have seen a profit. Not fantastic. Another one, if you started in August in 2019, not such a bad drawdown, but you would have waited another long period of time. It was quite a sideways movement. Fast forward to today, both those positions would still be up 108% and 83% respectively. So just shows you again, even copying and starting in really bad times, and it can be frustrating, and this is really where the patience comes in. It's still, when you look at that long-term performance, and you see where technology and where some of these companies that we've got in the portfolio is going, if you are copying now and you are down and you are frustrated, this is just something to keep in mind. So how do we deal with some of this volatility? For me, it's the portfolio is positioned into different sections. For me, it's the core section is where 70% of the value of the portfolio is. That's into the positions and the companies that I trust and believe in the most, that I follow the most. Companies like Shopify, like Starbucks, like Disney, like Zoom that we're using now. Zoom, by the way, also quite down. Zoom, fantastic company, another huge potential, I think, to reinvest in. But how do we handle some of the volatility? So a big thing for me is looking at the portfolio in this kind of way, and then also looking at cash. So before February this year, I think we were sitting at about 24% of cash, and that's exactly because of this reason. I kind of never try and time the market, but you could kind of see after last year, there's different market indicators that would show you that we're probably going to see some profit taking, some of this sector rotation. And I never time it perfectly, but as soon as it started dropping in February, you started using some of that cash. I think the latest round was in March 24th, and these are all the buys that I did during that round, and that was basically the last round of that cash in the portfolio that went back into those stocks. Some of those stocks that you saw there that has been battered the most, down 20-30%. Some of those trades you can see is now already up by quite some. So that's worked for me really well in the past. Something I'll continue to do in the future. So that brings me to the next point. As we're sitting here today, market down quite a bit. I would like to add some cash again to the portfolio. I haven't done this for quite some time. If you look at the history there, twice in 2019, twice in 2020, around about that time that COVID started. Again, not trying to time it perfectly, but one of my key fundamental things is, this idea of reinvesting back into the portfolio. So just something to note there. I mean, some people choose to, some people don't, and this is completely up to every individual copier. Again, it's the same as investing if you were investing like an ETF or some fund. You can start with your initial investment and just ride it through. If you want to reinvest into that portfolio, depending on your timing, it could have a big impact on that profit loss percentage overall. Over time, though, as you can see on that chart, it doesn't really matter when you added funds. Whenever you did add funds, it would actually have brought down your profit loss percentage if you started copying right at the beginning of that trend, right? So that's just something to also keep in mind. I've had some questions regarding this as well. So people saying, but they can see on my performance, if you look at the total returns over 300%, or for last year, it's like 80 or 70%, but they started copying a year ago, but they're only sitting in like 20% return. So that could be that if you started copying a year ago and you invested, let's say, $1,000, but recently at the peak before the drop, you invested another $5,000. So you invested obviously when at the same time when prices were what they were a year ago, and if you invested more money now recently when prices were higher, that would affect your profit loss percentage. So just something to keep in mind. But yeah, I would like to add some cash to the investment again. So like always, I always post like a week before, a week after, give everybody ample opportunity to follow along if they want to. So there's a couple of options there. Like I said, you can follow along. You'll get a notification from eToro telling you the exact amount of equity percentage-wise that I've added and the amount that you need to add if you want to follow along. If you don't, everything still stays as it is. It's like I said, if you invested in a fund and you didn't add anything, it stays as is. Everything's still managed, everything I open still opens on your side, everything I close still closes on your side. The only thing is if you don't add that cash at the same time, some of those newer positions I open with that free cash might not get open on yours, and the portfolio percentages might be a little bit off. But like I said, everything else still stays exactly the same. So why am I investing back in the portfolio? I think explain some of the reasons behind it, but I'm still very optimistic even in this market, even on a day like today. Like I said, I really think that for me, I try and make volatility work for me. So you kind of want that cash in the portfolio as a balance. It does a couple of things. It helps against the volatility, buffers against it. Also gives you opportunity to reinvest in these companies during times like this that you see the opportunity. I'm very optimistic. If I look at some of the company earnings releases that's come out the last week, it's been a very busy period. Fantastic earnings from big tech companies like Google, Microsoft posting incredible numbers. And then the stock tanks by 4%. It just shows you the market we're in is where people are like looking for, extreme outperformance. But those companies are doing fantastically well, and I think it's created a lot of opportunity again now where there hasn't been at the end of last year. Now there is opportunity again to put some new money to work into some of these companies. So just the last slide, and then we'll go to the Q&A. So just in terms of positioning again, another way that I like to look at the portfolio, these are kind of all the different segments or baskets into those different technology themes. So there's, it's grouped into those stocks for me into different sections like streaming, fintech, cloud, health tech, renewable energy, all those things. So again, I take like a basket approach. The thing like you'll see is, what commonly happens is in that basket of, let's say, fintech stocks, over the next year or 2 years, not all of them will succeed. Some of them will be down 10, 20%, maybe even more. But the 1 or 2 or 3 of them that do outperforms by, hundreds and 200%. So that's kind of the basket approach I take to all these kind of investing themes that really drives my curiosity and everything that I research and look into. So just to close off, this is the same slide I use all the time for all these calls. It hasn't changed since I've been doing this. So I never use leverage, never let a position take up more than 10% of the portfolio. Always like to keep some cash available and like to add cash in regular intervals during downturn. Like I said, that's been the same since I've started, and I think now is a good opportunity to do that again. Keys to success. This has been my investing journey since before eToro, when I started in 2007. Don't trade in ticker symbols, invest in companies. Patience is a key thing. Mentality in investing, I think is one of the key things to make a success. Warren Buffett talks about this a lot in his books. You don't have to be smart and understand all the financial, the metrics and stuff, but if you have the right temperament and the right mindset, you can be very successful in this market where a lot of people are not. Letting my orders run. So a couple of examples of that. Like I said, be mentally prepared for some of these pullbacks. It is just the nature of the game, especially in investing in high growth, technology oriented stocks. It is going to happen. If you can mentally prepare yourself for that, that's fantastic. It's impossible to predict these short-term market behaviors, but it is kind of easier to predict these long-term trends and what you'll see, where these companies will be in the next 5 to 10 years. And then I always try and build up a portfolio of quality stocks and can benefit from these kind of market trends, what we've been seeing in the last couple of years, really accelerating. And these things, like I said, they will continue to accelerate, I believe, far into the future. So that's my long story. I hope you find that not too boring. And if you have any questions, please feel free.